It is Friday, April 24th, and welcome once again to your Guide Through the Storm. I'm Bob Simpson, your host for this series of webinars. Thanks for joining this, the 7th webinar in our series, and thanks to those of you who have shared your appreciation for these seminars. We know that some of you tune in every week, and we know that there are others who tuned in to the first few and then got a feeling of comfort that where they felt that it was good that we shared the information with them, but they felt comfortable that we were taking care of them. And they've decided to leave it with us. Now, these sessions are meant to be more than updates. They're meant to provide you with the information so that you can really become an insider in your own investment strategies. And thank you to those of you who have made suggestions about topics and have submitted questions to help make these sessions more interesting. Now, today we are excited to have a special guest panel member joining Paul Tyers and myself on today's roundtable. Paul Sandhu is President and CEO of Merit Asset Management, Inc. He has over 30 years of experience in domestic and international fixed income. Prior to joining Merit in 2009, Paul was responsible for global distribution of Canadian fixed income and money market products at BMO Capital Markets, through offices in Toronto, Montreal, Vancouver, and New York, and London, and Hong Kong. Paul was responsible for advising some of the world's largest fixed income asset managers on portfolio strategy, asset mix, and security selection. His career also includes some time with Goldman Sachs and Citibank in Europe, the United States, and Canada. He has a BA Economics from the University of BC and a Master's of Public Administration from the University of Victoria. Even though he's a fixed income strategist, he's a great source of information to help us get a unique perspective about financial markets, the economy, and maybe even how we should be dealing with COVID-19. So, Paul Sandhu, thank you for joining us in your Guide Through the Storm.
It's a pleasure to be here, Bob. Thanks for having me.
Yeah, you're quite welcome. So first of all, I want to remind everybody that if you go to portfoliostewards.ca, there is a link there to all the recordings. So this session is being recorded, and you'll be able to go and pick it up later if you want to review it later on. So we start out each of these sessions by tracking the storm, see where we are. Number one, looking at performance of the strategies that we've been running. Our moderate conservative strategy is still down about 7%. The balanced strategy down about 8%, and the moderate strategy is now in single negative digits, down just under 10. That compares favorably to the TSX Composite at negative 16 and the S&P 500 at negative 13.4. This again, the storm that we went through, a series of really bad weeks, 12%, 8%, 14, 15. And that's been followed by what I'm calling the recovery phase, where we've had 3 positive weeks with 2 weeks that have been slightly in negative territory. This week we're down 2.5% roughly when I updated this slide. You can see by this slide, and this is on the left, the S&P 500, and on the right, the TSX Composite. And you can see that following the sharp decline, the markets recovered fairly sharply and then have gone into a sideways trading pattern. So my real question when I look at this, is this, and maybe Paul can address this when we get into the roundtable part of this, is this stability or is this complacency? So I'll just leave this with you for Paul. So just back with Paul, here is the series of webinars is entitled Your Guide to the Storm. Our goal through these is to help investors and our partners keep updated during this stressful period. And we're pleased to have Paul with us on the roundtable. Now, Paul, the ETF that you manage is called the CI Merit Alternative Absolute Return Bond ETF. Can you explain to our listeners how an alternative absolute return strategy differs from the more traditional bond strategies that are available to investors?
Yes, of course. So maybe first of all, just to step back for just a moment, why do you typically own bonds to begin with? Bonds, in our view, do four things for you. They provide yield and income. Now, none of us may be too happy with the amount of yield and income that they're providing at the moment, but that's a factor of where interest rates are globally and obviously here in Canada. But they provide yield and income. They're designed to lower your overall volatility of your portfolio. And they're designed for two other reasons, or that exposure to fixed income does two other things. One, it helps preserve capital. I mean, typically you don't want to lose money in bonds. And finally, it provides negative correlation to your other assets. So when other things usually go up, bonds may not be doing much, they might be going down. But definitely when other things go down, as we saw in March, and you showed some of those weeks earlier on in the slide, bonds should be going up. So they provide, a lift when everything else is going down. And that's important to have what we call negative correlation, something that goes the other way in your overall asset allocation. So the strategy, the alternative absolute return bond fund, is different because typically, when you buy a bond fund, it gives you exposure to sort of one class of bonds. So you might buy a bond fund that gives you exposure to, for instance, investment grade corporate bonds, so high quality corporate bonds. You might buy a strategy that might focus on high yield bonds. Those are lower quality corporate bonds. You can buy a bond fund that focuses solely on government bonds. You can buy like what's called a universe bond fund, which may give you a little bit of a mix of those things. But not one or all of them on an actively managed basis. The purpose of the Merit Alternative Absolute Return Bond Fund is to understand where we are in the economic cycle, where we are in the credit cycle, where we are in the interest rate cycle, and give you exposure to that part of the bond universe, because the bond universe isn't bonds, it's all those components: investment grade bonds, high yield bonds, short duration bonds, government bonds, provincial bonds. It's all of those things that give you exposure to that part of fixed income that we believe will give you the best risk adjusted return at the time. The economic cycle changes, the credit cycle changes, obviously the interest rate cycle changes. As those things change, the different parts of the bond universe will give you better return, will give you better protection. And so the idea of the Alternative Absolute Return Bond Fund is for us to understand how the cycle is changing, and then to rotate you to, so we make that decision to basically rotate you to that part of the fixed income universe, which we believe gives you the best returns. And this chart that you're looking at now, kind of describes that. Obviously, late in the economic cycle, when you're getting close to a recession or slow growth, you want to have exposure to government bonds. In the early part of an expansion, when the economy is recovering from an expansion, typically high yield gives you better returns. And then of course you rotate to investment grade bonds, and then finally late in the cycle, you probably want to have really short duration. You don't want to have a lot of risk anymore, but basically just want to have short duration focus in terms of your bond fund. In the next chart, you can see how we think about the cycle, the economic cycle. The economic cycle, there is a cycle for sure. And you can see in those top arrows that late in the expansion, you want to have short duration. As the cycle moves forward, and when you get to kind of more of a recessionary peak of the cycle, you want to rotate into government bonds. And then finally, when you get into the trough of a recession and you get into the early expansion phase, you want to own long duration credit. So you want to own more risk in credit. So you want to actually own corporate bonds and high yield bonds and so on. And you can see in the next slide just kind of how that works. Because here, this is kind of a heat map of how different parts of the economic cycle, have an impact on the performance of different parts of the fixed income universe. You can see, for instance, just looking at '08, all of us can remember that obviously we had a recession in '08. What you really wanted to do in that part of the cycle is have exposure to government bonds. And if you only owned 30-year US Treasury bonds in that year, you would have made a return of 41%. But once we got we started going out of the recession and the cycle trough, we moved into early cycle. You can see actually, in '09, the best place to be in fixed income for the next 2 years essentially was to own high yield bonds. Those gave you the best returns in fixed income. And typically, if we just look at that heat map from 1 year to the next, you can see that different parts of fixed income give you better returns at different parts of the cycle. So what our bond fund is designed to do, we are active managers. What we look at is where are we in those different cycles, whether it's the economic cycle, the credit cycle, or the interest rate cycle, and we rotate the assets in the fund to that part of the fixed income universe that we believe will provide the best returns for clients.
Okay, so that's awesome. Now, let's go back a couple of this. So I see that you've got a question mark on this slide, Paul. Is that where you believe that we are right now?
Yeah, I think I wouldn't necessarily, that's necessarily why the question mark is there. I guess this is how I would describe it. At the moment, we believe we are still late, very late, or probably at that peak, I would say, or very close to that peak. Now, that was before the virus. So let's just stop and think about that. As we came into 2020, it was very clear that we were late expansion and probably had hit the peak. And quite frankly, in our view, we actually hit the peak in economic growth in this cycle probably in early 2018. So, that's a while back. And so, yeah, we probably hit the peak in 2018, and we've been slowly moving down. So there's no doubt that that's why we rotated. When we kind of hit that peak, we started reducing our what we call risk in fixed income, our exposure to things that are more risky, like corporate bonds or provincial bonds, and started this basically focusing on purely sovereign government bonds, so bonds issued by the government of Canada or the US Treasury.
And now, if on this chart you show short and long, and just for the sake of the viewers here, what do you mean by short? What kind of years? How many years do you consider short?
Yeah. So you'll see that word duration, and duration is a word we use a lot in our vocabulary as fixed income managers. But duration just refers to the amount of interest rate sensitivity that you want to take, right? So it really is a formula that describes how much interest rate risk you're taking, and for each unit of interest rate risk you're taking, how much volatility your bond fund will have. Well, clearly, if you look at, again, those arrows at the top, when you're getting, when you're at the peak, you know that if the economy's at the very peak, you probably know that interest rates are probably at their high, because if the economy is running at a very high level, the unemployment rate is down, the output gap is very small, and everything is going, growth is, economic growth is high. Governments typically are at that time are raising, right? They're raising interest rates. And so when governments are, sorry, not governments, but central banks are raising interest rates, when interest rates are going up, you want that least amount of sensitivity to interest rates, right? So that means you want short duration, right? So you don't want to have a lot of sensitivity to interest rates. You actually want to have low duration, but you still want to have some exposure in the late expansion to corporate credit, because your corporate credit is giving you a higher yield. But when you hit the peak and economic activity starts to decline, then what ends up happening is central banks move quickly to cut rates, and we've seen that obviously in spades in the last few weeks or month. I mean, both the Bank of Canada and the Federal Reserve have cut interest rates 150 basis points or 1.1.5% in a period of two to 3 weeks. So when interest rates start going down, you want greater sensitivity in your bond portfolio to interest rates, right? So you want to have long duration, no longer short duration. So when interest rates are going up, you want short duration. You don't want sensitivity to interest rates because that hurts you, right? But when interest rates start going down, you want to own bonds that we call longer duration. So in other words, bonds that might have a term of 5 or 7 or 10 or even 30 years, because they have a greater level of interest rate sensitivity, and therefore they'll benefit from interest rates going down. And that's why we say you want longer in that second arrow. We say you want long duration government bonds when you hit the peak and start moving down in a slower growth path, because central banks are then cutting interest rates, and you want to have that exposure, as much exposure as you possibly can have, to that decline in interest rates, and that comes from duration, that sensitivity of your overall portfolio to interest rates.
Right. So you want to hold longer term bonds when interest rates are high and or falling, and you want to hold shorter term bonds when interest rates are low and are rising. Is that
right? And during that shorter duration period, you want to have shorter bonds, but you probably want to typically own more corporate bonds then, because they're providing you with extra yield, but with a shorter duration, with less interest rate sensitivity.
Yep, and I think we have a question that was posed here. Would some people refer to this strategy as market timing?
Maybe you could. We don't really kind of think about it from a market timing point of view. We do look at, we have a history of doing this for quite a while. Barrett's been in business for 20 years. Most of the people who work with me have more than at least 20 to 30 years of experience in doing this. We focus a lot of our resources on understanding the economy, basically the economies of the world. The thing that we actually spend a lot of time is understanding where global growth is, and we do all of that work ourselves. So what we do is we take economic growth, and we look at economic growth in each industrialized country in the world, and then we include China. And basically what we do, if you take all the industrialized countries in the world and include China, what you do is you capture about 65 to 70% of all GDP in the world. So what we're trying to do is say, listen, we're capturing a large part of GDP in the world, where we study every country individually. We look at all of their economic policies, right? All of their economic data, all of their central bank policies, and based on that, we basically come up with a growth forecast for that individual country. And then we aggregate up every individual country growth into a global growth forecast. Typically, what that does, and what that has done historically quite well for us in our process, is it tells us where we are in the economic cycle and in the credit cycle. And that's the most important thing for understanding how much, where you want to be in the fixed income universe. And we never think about, if you want to call it market timing, we actually are looking at the cycle, and we know we're never going to capture, the actual top of the cycle or the actual low of the cycle. That's not the point. So it's not about, the number of times in my entire career that I've, bought the low and sold the high is probably, I can count that on maybe with two fingers, right? What we're really trying to do is to say, do we have a pretty good idea, where we are in the cycle and when we start doing that rotation? And you don't do that rotation all at once, right? What you do is you start doing that rotation because it's affirmed in your analysis, and then you start you start accelerating that process in terms of that rotation more fundamentally. So just as an example, if you were looking at our funds through 2019, you would have noticed that we were moving away from owning corporate bonds and high yield bonds and adding more government bonds. So basically, if you look at that cycle chart, we felt we were late expansion and that we were getting near the peak. And in fact, we were probably past the peak in our view, because we felt we passed the peak in the latter part of the fourth quarter of 2017 or the early part of 2018. But that didn't mean that we switched completely, that we sold all of our corporate bonds and bought government bonds. What we did is we started recognizing that the global growth was probably about to roll over or starting to hit that apex. And that meant to us, hey, slowly we need to start, start rotating out of one particular fixed income universe, our asset class, into another. And the other thing that tells us that, by the way, along with just understanding kind of where we are in the cycle, is valuation, right? Everything has a valuation, whether it's government bonds or corporate bonds or stocks. So when we believe that the valuations, okay, in for instance, an investment grade bond or a high yield bond, or even for that matter, government bonds, reach a level that we think is expensive or cheap, that also usually tells us something about where we are in the cycle as well. So typically when you get late in the expansion, the economy is doing well. You also figure that companies are doing well, their earnings are doing well, and that means that in our world in fixed income, the premium that you get paid to own a corporate bond goes down, right? Because the company is doing well, the economy is doing well, etc. So as that premium goes down and down and down, and you're not getting paid much to, for instance, take that risk, that is a signal to us where when we don't get paid to take the kind of risk we're taking, we want to rotate out of that, right? So it's a matter of understanding where we are in the cycle, along with valuations that made us do what we did all of last year. Throughout 2019, all of our funds, you would have seen, we're gradually selling corporate bonds and high yield bonds and adding government duration because of valuations, and secondly, because of where we thought we were in this cycle, as is shown in that chart.
Right. So would you, Paul, would you say that it's not so much market timing as it is strategy?
Yeah, I guess it's strategy. I mean, it's a very disciplined strategy. We've done this for a fairly long period of time. We know we're not going to get the absolute correct. We're not going to get the absolute low or the absolute high ever. What we're really looking to do is to sort of say, hey, is everything lining up to make it, to make us understand and make us convicted where we are in the cycle based on valuations and our economic analysis. And what we're really trying to do is to say, hey, we're trying to get the direction right. We're not going to necessarily buy the high or low. We want to get the direction right, and we want to be sure that we can get the direction right over 75% of the time, and that we can capture 75% of the value of the entire asset class during that part of the cycle.
Right. So I think it was Warren Buffett who said that you're simply trying to be approximately correct and not precisely wrong. Is that?
That's pretty much it. And that batting average of 75 and 75 is really important. We talk about it all the time. We want to get the direction of the market right, correct. We want to get where we are in the cycle. We want to get that correct at least over 75% of the time. We want to capture 75% of the move. If we do that, we know we will consistently outperform any of our competitors. And so that's really what the team tries to do. And that was very much what our thinking was through all of 2019, when our portfolios were actually really rotating out of credit and into government bonds, which is why if you look at our performance in 2020, was the right thing to do. Valuations, we were late in the economic cycle. Valuations were very, very rich in certain parts of fixed income, and you needed to move out of those and get into a place that was safer and likely to provide you with better returns.
Right. So we have a question, which is, can you give a quantitative answer to how successful your strategy is being, and maybe start with by positioning your investments the way that you did as we entered into the COVID-19 era. How has your performance compared to, let's say, a corporate bond manager who was simply a buy and hold corporate bond strategist?
Yeah. So if you want to maybe go back to that, to the next chart, that one with the heat map on it, can show you a couple of just quick things, and I'll talk about the more recent experience as well. But if you look at that heat map with those different different.
That one or the next one?
No, the heat map, the one with all the different returns. The next one. You can see, for instance, how in 2000, we will all recall we had that recession in 01, 02. So that was the dot-com bubble. And so we had the recession in 2002. And then the following 2 years, pretty much one of the best asset classes to be in fixed income was high yield. We caught that very well. And in 2008, again, we had a recession. In that year, in 2008, you will look to see that high yield bonds had, at the bottom of that chart, you'll see that high yield bonds had a return of something like minus 28% or something. Thereabouts. I can't see it. Yeah, it's minus 26. So if you owned high yield bonds in 2008, you lost 26% of your return. Our returns at Merit, where we were down 2.8%. And so, basically that tells you what were we doing? Does our process work, or, does it work reasonably well? Yes, we lost 24% less than what everybody else did who had a passive strategy or had exposure to high yield. And again, that rotation, what we did in 2008, we owned a lot of high yield bonds in 2000, 2003 and 4, and going into 06 as well. We rotated out of high yield and investment grade bonds, so higher risk bonds, in 2007. And we were very explicit in telling our clients what we were doing, because we felt, hey, we're at the end of the economic cycle and the valuations in this asset class are too rich. In other words, you're not getting paid to take this kind of risk. Anytime we look at valuations and we say, hey, what's the risk reward? Are we taking, is there a risk reward equation here that we like? If we don't, if the risk reward is skewed heavily against us in our view, then we rotate out based on the economic cycle and valuations into what we think will be the best performing asset class in the next part of the cycle. So, yes, in 2008, the reason we lost only 2.8% and the high yield market lost 26 is because most of our exposure was in government bonds, a 30-year treasury, which, as you can see, in 2008 was up 41% in that year. Now, going into 2020, we did something very similar to what we did in 2008. We reduced our exposure to high yield and investment grade corporate bonds because, again, we felt it was late in the cycle and because valuations were incredibly expensive in those markets. And I have to maybe remind your audience that a lot of investment managers were buying corporate bonds and high yield bonds to get you more yield, right? They were sort of going, hey, well, government bond yields or interest rates are low. People want more return in their fixed income, and because government bond yields are so low, we're gonna push out further and take some more risk and own investment grade bonds or high yield bonds to get you higher yield. And people felt apparently they felt good about that. In our view, what people were paying to take that extra risk was way skewed to the downside. In fact, going into 2020, corporate leverage, so the balance sheets of companies, corporate companies, was the worst that we've ever seen it. They were very, very weak. And what you were getting paid, what we call the spread, the additional premium you get paid to move from a government bond to a corporate bond, that premium was very low. So the risk reward of getting paid very little to take a lot of risk didn't make any sense to us. So in 2019, we started rotating out of corporate credit because of those valuations and because of our determination of where we were in this economic cycle. We were very late in the economic cycle. When you are late in the economic cycle, you don't take more risk, you take less risk. And so we entered 2020 with very little corporate credit and a whole bunch of government bonds. And people, I will be very frank with you, people were saying to us, well, government bonds have, there's no yield, interest rates are so low, why would you want to own government bonds? Well, we were quite convicted that, one, you don't want to be in corporate bonds because the valuations are too rich, the risk reward is not good. And if economic growth actually is to the downside, then central banks will be forced to cut interest rates. And even though interest rates are already low, if they get forced to cut interest rates, owning government bonds with that longer duration, right, that higher sensitivity interest rates will be the right way to be exposed. So at the end of March,
If I could just
yeah,
get in a sec,
yes,
just for the sake of time, couple quick little questions for you. One is, if you did the heat map for 2020, how do you look performance-wise versus
yeah.
versus
So if you look at
corporate?
so if you look at the investment grade at the end of March, in exposure to investment grade bonds in Canada, you would have been down about 5%. In the US, you would have been down around 11%. If you owned high yield bonds year to date at the end of March, you would have been down probably around 20 some odd percent. The strategy that we're talking to you about, the Merit Alternative Absolute Return Bond Fund, because it had no credit exposure and only exposure to government bonds, was up about 4%. And now, year to date, as of probably yesterday, it's up about 6.5% on the year.
Right. Okay, so that's perfect.
So we have positive returns. We have positive returns when pretty much everything else has negative returns.
Yep. Yeah. So in the short term and over the long term, and for the person who asked us the question, we'll get you some longer term numbers. Just we'll respond to you directly. So quick question, because we need to wrap it up. So maybe in 2 minutes, can you give us an idea of, we've been through the storm. We're now, the question that I sort of posed in the beginning is, are we in a period of complacency, or are we in a period of stability? Or what do you see happening, let's say, over the next, either the short term or let's say over the next 12 months?
Well, in over the next 2 to 3 quarters, we do like the idea of rotating more into corporate bonds. And the reason for that is that we had a big correction in valuations, right? I said earlier that in 2019 we didn't want to own corporate bonds because the valuations were so expensive, and we were near the end of the economic cycle. We've had a very significant correction in March in valuations to levels that we normally associate with incredibly deep recessions, and we don't think that this, although the economic impact of COVID is going to be very significant, we don't think this is a typical structural or cyclical recession. It is an event-driven recession. And event-driven recessions tend to be shorter and shallower than cyclical or structural recessions. And given that everything got really cheap, and we kind of think that the recession is event-driven, i.e. there's a time period where it'll end, and I'm not saying we know exactly when that is. There is some uncertainty to that, but we do know that the virus has a life cycle. We determined that, hey, valuations are now cheap. This is going to be an event-driven recession, which is shorter and shallower in type. And beyond that, we have had a very strong monetary response. So monetary policy, interest rates have gone down. Central banks have introduced a lot of programs to support the market. And in addition to that, fiscal policy, i.e. government policy, has also been very aggressive, where governments are making sure that they're looking at the economy and what is being impacted by the economy and ensuring that there's money for those parts of the economy. So that combination of the event-driven recession, along with cheap valuations and aggressive monetary and fiscal policy, has allowed us to rotate out of some of our government bond positions and starting to add corporate bonds, because we believe corporate bonds at these valuations will provide good returns over the course of the next 2 or 3 quarters. But to answer your question about kind of what do we think in the longer term, I will say to you that we continue to believe that we are still in a part of the economy that's very fragile, and we don't see this, coming out of this as being in a stronger place in the economy. We do continue to believe that there are 3 big headwinds to growth, and these headwinds are going to persist, and they're not going to go away. And we have entered a period of low growth, low inflation, and low yields because we have too much debt in the world, because debt to GDP is at the highest it's ever been in history. We have very little population growth, and we have incredibly low productivity growth. And those 3 things, credit growth, population growth, and productivity growth are the three things that actually drive economic growth, period. And so if each one of those is stretched, then we're not going to get a lot of exceptional high growth. And as a result of that, we do think that the period ahead is one of low yields, low inflation, low growth, but also that means a lot of volatility. So although this has been a really good opportunity to take advantage of adding corporate bonds to your fixed income, which we are doing because we have done that already, because we think that they'll provide good returns for us, we also want to understand, given the backdrop that we have in the global economy, that this will be a period of volatility, and we want to be just as tactical selling those corporate bonds when we've realized good returns from them and get back into kind of safer positioning.
Okay, well, thank you very much. We've run sort of the term that we try to do with this. Paul, thank you for sharing your thoughts with us. Now, just a note to viewers, and that is that, and we'll send emails out with this, it is our plan to, because we've either reached a point of stability in markets compared to where we were over a month ago, we're going to scale back your Guide to the Storm to bi-weekly. So the next session will be May the 8th. So there'll be no session for next week. We look forward to you there. So Paul, thank you for joining us. Thanks for sharing this amazing information. Paul and the work that he does will become part of the Wealth Stewards Portfolios going forward. We believe that Paul and Merritt, his firm, do great work, and we think that by having them as a partner in our investments is a outstanding idea. So thanks again for joining us, Paul. Thanks to everybody else for joining this week's Your Guide to the Storm. Have a lovely weekend, and we'll catch you all in a couple of weeks.